Welcome back. This time we have 5 top dividend stocks that could potentially outperform in the year 2025. We're talking about relatively larger companies. That means the growth potential is likely a bit lower, but they do pay out relatively higher dividends. And because they are a bit bigger, have established revenue models. With a spread across multiple countries, they may also provide a bit more security for the future. So these 5 larger companies with relatively higher dividends are interesting for people who already have a lot of money and who want to enjoy a relatively high dividend a bit more, and also a bit more security in the portfolio. Of course, you also want dividend growth stocks, because you always want a mix in your dividend portfolio. But that aside, so here are 5 top dividend stocks that could potentially outperform. We have selected these stocks, and we scan hundreds, thousands of stocks per week. And we do that based on different data tools, and we pick them for our YouTube videos. So every now and then, 3 to 5 out. So those that could possibly be in the book, they can outperform purely and solely based on statistics. That works better than you would expect. It's also emotionless. But that aside, now, you are new to our company. My name is Jorik Vermeulen, founder of Happy Investors. I started saving myself from the age of 23. I became financially free at the age of 30, now a bit older, and on the way to financial independence. And we also offer products. But through our YouTube channel, we also offer a lot of inspiration, and everything is, of course, before and after research for yourself. What you want to know, what we find to be the best dividend stocks from all the research we do. Every month we publish one top dividend stock that we think can outperform, both in terms of nice dividends and also growth, because we are always focused on growth potential. And we do that on our website, Happy Investors, but that's not necessarily needed. You can also just watch all the videos we share with you and do your own research. I also like to share that. I hope you find it useful. If you have winners thanks to us, let us know. That's really great, always motivating. But before that, let's take a look at the top 5 dividend stocks of this month. We're doing a little update, a milestone for myself then. Look, a milestone has been reached in the balance of my portfolio. At Giro, it's 200,000, actually for the very first time. And this is private wealth. I also have a business portfolio, but it's nice to see that the 200,000 has finally been achieved. Every month, I give an update on my investment portfolio, including buying and selling shares in ETFs. So follow and subscribe to our channel. Then you'll stay updated on the monthly update. Just a side note, nice, we'll definitely email. And I'm also going to link a nice event to it. Event linking the first dividend stock that might be interesting. For this year, it's Mizuho Financial Group with the ticker MFG. And this is a Japanese bank. Does all kinds of banking. That's the short summary. And we're going to look at a few characteristics of why it could outperforming in 2025. On the other hand, there are some caveats. But to be honest, so let's get started right away. Now, the price target from analysts is around 5.9, and that's an average price target, but from just one analyst. So yeah, you don't get much out of it. This analyst really believes that there is upside potential. Now, it's also an advantage that there's very little coverage of these kinds of stocks, because that could actually turn out to be quite positive, especially if you know a lot more than the average investor about this company. Morningstar gives a 3-star rating. Furthermore, they indicate no economic moat, pointing out a few pros and cons, not really anything special. If we look at the long-term potential, that they always do, of course, as the first thing, then we see that the current price has been moving horizontally for a long time. They have indeed cut the dividend, but it's not great. Dividend stock. Recently, there's been a significant increase, and this is why it has now become a top dividend stock, because momentum is an important criterion in the tools that we use. But here we are looking at the historical valuations, and it seems that the stock is still below the fair value line, undervalued. So it's below the intrinsic value, where the price to earnings ratio is 15. It's really just a question of whether that's true. Normally, the historical valuation is a price to earnings ratio of around 9. We also see that this is on a 20-year level. Now, let's assume that, and below we see the EPS. Analysts' estimates where it is more fixed, namely 14 and 9. Yes, even though you have a significant increase in earnings growth, the price to earnings ratio is only 9. And the current price to earnings ratio has risen to 12.7. So that basically means you can hardly achieve any return. And note, this is including dividends. So basically it is price yield already minus 11%. But the The price doesn't just start to rise for no reason. So the question is, what's going on here? And it could be that this stock will surprise this year after all. And it's up to you as an investor to do the research of, yeah, it's all good. So I make investing fun by knowing more than someone else. And that is the crucial question. Do you know something that the market doesn't know? Is it positive? Yes, well, then you can buy, because then you might have outperformance in your hands, but you have to be sure about it. Let's take a look at a part of the valuations. First of all, I'm starting with these are big companies. Well, the market cap is 70 billion. They obviously have a strong balance sheet, both debt as cash. It's a bank. And if we look at the valuation, it has indeed gone up a bit, as we've discussed. And then the year is estimated at 12.9. The failure rate for this model is actually a bit lower. Price to cash flow, interesting, is indeed a bit lower. And the dividend yield is about 2.9%. Looking at the growth, at first glance, the revenue growth doesn't seem interesting, but the EPS growth is estimated to be quite interesting, around 14%. We also saw that reflected here in the other data tools. What we also see is that the revision gets an A. That often means that analysts expect the company to make more profit than initially expected. And the momentum is also very strong. So it could be that there are fundamental factors here that will lead the company to make more profit. It's up to you as an investor to investigate that further. The net profit margin is relatively high at the moment and also slightly above the 5-year average. It's always good when a good profit margin is achieved, but the return on equity is quite low. And also the 5-year average of 5.8% is low. If I quickly look at these characteristics of such a company, and certainly also take that into account, keep the dividend yield, and I would choose the dividend stock, then this wouldn't be a choice for me as a long-term investment. But it can outperform because it actually scores very well on the different factors, and that it is way so predictive value for the next 6 to 12 months, but not 100% guaranteed. So that's obviously a very big difference. The dividend yield is then estimated at around 2.8%. If you look at the dividend history, there's not much exciting to report. They do pay out a lot of dividends every year, though, but there isn't much dividend growth happening. Look at the very short term. Then Zexkink gets a hold rating. And when we look at the price, we see a strong increase in momentum. That also explains why it suddenly scores so high in the factor analysis. And this momentum can often continue strongly. So that's the question. Will the momentum continue? Yes or no? And is there something to consider here? Namely, will they make more profit in the future? If you zoom out, you can see a different story. And before the financial crisis, it was much higher. Well, it's now 20 years later. So you also see, suppose you had invested in 2010 or let's say 2009, you would still not have actually achieved any return. Today, maybe dividends every year, say 2 or 3%, but that would get eaten up by inflation, so it would be a super bad investment. So it's super interesting to investigate here. Who is the old financial group? Can they really continue this upward trend? And if so, what are the catalysts behind that? And if so, what are those catalysts? What is the fundamental growth that it will achieve in the long term? That couldn't have been the case. But what is the fundamental growth it will achieve in the long term? And what are the drivers behind that? Interesting to look for afterwards. Note, it's a top dividend stock, so it can outperform over the next 6 to 12 months. But if I look at this quickly, it's also a bank. Usually not the most attractive long-term investments. Moreover, it's also in Japan. And you know what the current situation is in terms of Japan, in terms of interest rates? So that's about this stock. Let's take a look at the next top stock. The second top stock at the moment is Iberdrola. I'm not known for my great quotes, so keep that in mind. And Iberdrola might be an interesting dividend stock for both the short and long term. If you don't know the company, they are based in Spain. Yes, gas, electricity, but mainly sustainable electricity. What that does, and they also invest huge amounts of capital. Just take a look on the website at how much money they are investing in a bit of sustainability. But sustainability is, of course, also here and there. Yes, yes, yes. Under pressure regarding profitability, especially wind turbines don't seem to be very profitable. Just take a look at Vestas, wind systems, and solar energy. Yes, maybe a bit better, but that's still up for debate. Now, Iberdrola is one of the few companies that actually seems to be able to do it, to make it profitable after all. Or is it maybe secretly the oil aspect and the gas aspect of what they do? The Morningstar rating gives a fair value of 12.7, while the current price has risen to 13.5. It's still a bit on the high side. Look at other analysts. They give a price target of around 14 on average. There are some important things we need to take into account, especially the debts. Just take a look. However, based on the historical valuation, we see that this price is nicely aligned with the fair value. That stands at 15. Namely, the price to earnings ratio is 15. If we zoom in a bit on the short term, it still seems to be on the fair value line. And if we look at the normal multiple, it's a bit higher. In the past 5 years, personally, I would always stick to 15 times. We see the EPS estimates, and if we put all this into the model as a scenario calculation, then we can expect an average return for the next 3 years. That can go up to about 7% per year. But this is including dividends, so it's not super high. Attractive dividend or price return that you could achieve. And of course, the price could also rise. For example, up to 18, then you have a higher return. But that's more wishful thinking. I would always assume a more pessimistic scenario myself. Not to be pessimistic, we are actually optimistic about investing, but you can better count yourself poor than rich. Look at the long-term growth. Then is the EPS growth is around 7%. Let's say you use a price to earnings ratio of 15. Before the long term up to 2030, you could achieve an average of 8% per year. Well, that's obviously not enough to beat the S&P 500. So why would you invest in this company if you could possibly achieve a higher return than the S&P 500? Well, I'll let you in on a secret. Why? The price to earnings ratio is around 16. Let's take a look at the model. For next year, it's estimated to be around 12. The S&P 500 is currently very high. The price to earnings ratio is above 25. So simply put, valuation is always important. And the lower the valuation, the less growth you need. That gives a bit more certainty for the future. So Iberdrola, but also a lot of other European stocks, simply have a better valuation. If you ask me in terms of risk and return potential, both in the long term and in the short term, at least for the next few years, the PE ratio is definitely on the higher side. We always prefer to see this below 1. The quarantine cash flow looks healthy. The dividend yield is relatively high, 4%. So that might also be a reason why you want a relatively higher dividend in your portfolio. But keep a close eye on the total debts they have. They have quite a lot of debt. Always look at the debt to equity ratio. In the short term, solvency seems to be in order, with quite a significant cash position. But you know how it goes. If everything goes wrong and a depression or recession hits, companies with high debts are always hit harder. So yeah, that's always a big and risky buy. Restriction that at unforeseen events can cause a company like Iberdrola with high debts to drop very quickly. Good numbers, nothing particularly special to mention, no added value. We see the profitability here. The screen with an income margin has risen to about 15%, while it's normally 10%. So they are doing good business somewhere. But here the question might also be, is it not a momentum? That means that maybe the net income margin could drop again. So here the question is it a fundamental increase? In the profit margin, return on equity is relatively high at the moment, and also 5,000 on average is above 10%, not superior. But hey, it can always be worse. So those are definitely more positive things. The dividend yield for next year is estimated to be around 3.3%, so a bit lower, and they are not really very consistent in the dividend payout. And you can also see that the dividend payout is also not always quarterly. There comes a moment when they don't pay out dividends, so it's not super consistent either. That's why it's not really a great dividend stock when you compare it based on dividends, safety, growth, yield, and consistency. And the dividend stocks that we select on Happy Investor, one every month, they always score high, also on this dividend scorecard, because you definitely want regular dividend payouts, preferably with dividend growth. And dividend growth is very important in our analyses. In the short term, Iberdrola gets a buy rating of 6. Well, that's for the very short term. And they give a price target of $63. Here we're talking in dollars. Earlier we were talking in euros. While the current stock price is $56 right now, so a slight upside potential of about, let's say 15%. Now, based on the technical analysis, the short-term momentum is starting to fade a bit. We can see that too. By the way, he's there to be present, but the MACD is also starting to decline, so that's usually not a good sign. Signs, maybe it will drop to 13, but it could also just as easily drop a bit lower, and that would of course be a better entry point. In any case, dividend stocks are always more suitable for DCA. That means every month or every quarter, buy more. But what I would always do is look at the volatility of such a company. First of all, and this is fundamental, you have to believe in the long term, the potential of companies, otherwise you won't buy more. And the more volatile it is in that case, the more attractive it becomes, because then you want to buy more each time there are larger drops in this case. Let's say minus 15%. If it drops that time by minus 30%, then you buy even more. And so you keep repeating that spiel, and in the meantime, you just let your dividend work for you. Positive, well, an upward trend, but as I said, those debts are relatively high. It could very well be that a new crisis is coming, you never know. And a downward potential of 60% in this case, yeah, who knows? It can repeat. So pay close attention to your money. And with your diversification, I wouldn't invest too much money in it due to high debts, but that's completely up to you. A third top dividend stock, possibly the most interesting of these five, it's Synchrony Financial with the ticker CXF. Let's take a look at this company. What a financial company it is. It offers a number of financial services. Are we looking at the analysts' ratings? They indicate a buy from an overall price stalker. That means a plus 15% compared to the current price. Let's look at the Morningstar rating. It really only gives 2 stars. Why? Well, first of all, we indicate that it doesn't really have a sustainable competitive advantage. And if it does exist, then it's also negative. So that's quite impressive. The fair value is $58, according to their estimate. And the current price has really gone up quite a bit and could still rise further. It's a top stock because it scores high, especially on momentum. The question is, how far can it rise? If we look at it based on the price, it correlates with the EPS. Yes, then it might just grow a bit further. But the question is, which multiple are you going to use? The normal multiple, which is the blue line, or the fair value multiple? What the orange line is? Well, this is a financial company, not a super scalable online earning model, but maybe that's something they're working on well. So personally, I would go with the normal multiple. The normal multiple, what does that mean? Well, that price Morningstar estimate has gone up a bit to around 10 for next year. Here we see the EPS estimate, and they are quite attractively high according to many such analysts. Yes, and that normal multiple, over the past 5 years, it's been 8, but for the past 10 years, for example, it's been 9.8. So let's take a bit in the middle, that 8.8, because sounds fair and is also somewhat in line with the sector. So we have 8.8 ace price to earnings, and then it could be that the average return is around 11%. But I say, of course, because this doesn't go in a straight linear line. It goes with ups and downs, so you can increase the potential return. And the crucial condition for achieving that average return of 11%, including dividends, is, of course, if these EPS estimates are correct, and they are never 100% correct. It could also turn out higher. Let's make that clear. Look, that valuation at the moment seems relatively low. According to the other database models, it's even a bit lower than what we see here. That's an 8.8 for next year. The PEG ratio is below 1. That all looks very promising. The price to cash flow also seems very low. So it seems like it's very interesting, but after an investigation, it's always necessary. Now, total debt might seem high, 15 billion, but they also have a lot of cash. So in that case, it's of course a financial service. Always study the balance sheet. It can always turn out badly if they do crazy tricks accounting-wise. But yes, that's trust in the leadership. So you also need to thoroughly investigate the leadership, especially as a long-term investment. The dividend was indeed on the lower side. So 1.5%, it's not great either. Dividend growth, share, but maybe in terms of price return, if we look at the EPS growth estimate, those are indeed quite high. Let's look at the profit. That's already relatively high at around 7.3%. And the interesting thing is that the return on equity is very high, even over the past 5 years. So there are a few interesting characteristics that make it a top dividend stock for this year. But if you're purely talking about high dividends, yeah, where's the downside then? It's not super high. The dividend, and that 1.5% will fluctuate a bit. The dividend history is relatively inconsistent, so they pay out the dividend for 5 or 8 years in a row. But there's almost no dividend growth. I think it's around 4%. And the sector median is around 6%. So it's definitely lower than average. In the short term, ZEC is giving a buy signal. Okay, interesting. And the price target they indicate is $72. So a little bit higher than the current price, but a bit lower than the average. Analysts have issued And our important warning is that the price has broken well above the EPS line. And what you actually always want is buy when the price is below the EPS line. But yeah, well, you never know if it will keep falling or if it will keep rising. So that's the question. Keep in mind that it could happen, that there could be a morning correction in the short term, but the valuation isn't super high, so that might offer some opportunities. But you can see from 2021 to 2023 has dropped by 44%. 2 years, well, that's not great result. So it could be that the momentum has gone too far here and that it will drop further. Or it could be that the momentum has a good reason, more profits are on the way, and the stock will continue to rise. It's up to you to investigate what is true. Omega Healthcare is a real estate fund with a relatively high dividend. And when you talk about the long term, they invest in elderly care. So in the long term, I think it's quite relevant. They have investments in the UK and especially in the US. Take a look at the website. There's a lot of information on there. Total real estate investors is about 11 billion. One thing that stood out to me as well is that the CEO, has been active since 2002. Doesn't have to say everything, but often it's a good sign that the CEO has been around for a longer time. Guaranteed. By the way, the company has been paying out a dividend for 20 years in a row. So it's good to know what really matters as a dividend investor. The ticker is OHI, Omega Healthcare. Well, they are, of course, active in healthcare. And we're going to look at a few characteristics of why this could be a top dividend stock with also a high dividend. First of all, the analyst ratings. The current price is around 37. They indicate that there could and be 30% upside potential. And Morningstar, it gives a 4-star rating with a fair value estimate of $41. And Morningstar looks at the intrinsic value, which is for the long term. But before you start cheering, Morningstar regularly adjusts the intrinsic value. So yeah, what exactly do you get out of it? When the cooling goes down, they often adjust the intrinsic value downwards. So yeah, you don't really get much out of that, I have to say. So it's better to do your own research and determine how much the fund is actually worth. Well, in this video, we're going to look at a few characteristics. Let's take a look at the characteristics. What we see in the historical valuation is that the price is finally a bit below the fair value line, which is the orange line. But you can see in the past that it has often happened that it even lies below this blue line, which is the normal multiple. And the normal multiple is significantly lower than the fair value line of the price. We're looking at the price, AFVO, adjusted funds from operations, because it refers to a real estate fund. Let's look at potential returns. What could it be? Well, if you stick to the normal multiple, that's a price drop of around 11. That's definitely on the lower side, definitely compared to other types of real estate funds. But okay, there is no reason to assume that it could be higher. Now, the current price drop has risen to 13.8. Here we see the profit estimate from analysts, and we stick to the normal multiple. That means an average annual return of about 3.7% for the coming years. That's not really super interesting. So when does it become more interesting? If that price drop stays the same at 13, then it starts from 9%. Then it becomes a bit more interesting. But yes, of course, the question always arises here. How much return can it actually achieve? So it's better to calculate a bit more cautiously and settle for less if you want to invest in this. Still, the stock can surprise us. It's currently rated a strong buy based on factor analysis, and that's actually due to the combination. So, attractive valuation, higher profitability, momentum, and revisions. In other words, analysts expect it to make more profit. So, now and we can also see that reflected in these analysts' ratings, and we will see in the short term that there might still be some profit to be made. If you want to invest a bit more actively and also have some patience, that valuation is maybe a bit more attractive, but not super attractive. If we look at the prices for next year, it's around 13, and that's slightly lower than the sector average. Well, but not much lower than the sector average. And don't forget that there are also other great real estate funds. So we regularly do analyses on real estate funds that might be interesting. And there are definitely a few top picks for the long term. The good, it's not that interesting to mention, besides the fact that people expect the EPS growth to be quite attractive, with about 3 to 4%. Well, that's always more than 0%. Let's take a look at the profitability at this moment. Then we see as we scroll down a bit that the return on total assets is indeed a bit higher than the sector median. Also, the return on capital is higher than the sector median. But yeah, 4% isn't extremely high. Well, what's interesting is that the mutual equity is 10%, and that is indeed significantly higher than the sector median. And the mutual equity is, of course, important for a real estate fund, so that might be interesting. Let's take a look at the dividend. Well, they pay out a high dividend. For next year, it's expected to be around 7%. They pay out a lot, of course. The payout ratio is 90%, but that's, of course, what real estate funds have to do. They have to pay out a lot. And we see that for 20 years in a row, they have been paying out dividends. This has been interrupted for a while, but they have been paying out dividends for 20 years. And the dividend growth is not remarkable. But yeah, in the very short term, recently we've seen a price drop of about 10%. Of course, if you keep adding each time, at minus 10%, that can be attractive, provided it's a real estate fund. In the long term, it grows, and the same goes for every company. Also take into account opportunity costs. But what we see is that the fund has been moving fairly horizontally over the years. Only because of the coronavirus crisis, it had dropped significantly. Before the coronavirus crisis, it was about 15% higher. And what you see are actually some regular declines here and about minus 30%. That's happened about 1, 2, maybe 3 times. Even putting the coronavirus crisis aside, it could very well drop back again. For example, to the minus 15%, and there finds a new support level. But if you believe in technical analysis, I'm not saying it's wise, but if you believe in it, and there is certainly some truth to it because there are multiple players who do that as well, then you can see that there might be a possible support level here. Well, the valuation isn't extremely high. The factor analysis is positive. There is momentum and it's quite strong, so there might be a reason to assume that it will continue to rise. And the question is also why analysts also expect that the Omega Healthcare is going to make more profit. So now, maybe it's expected. So there might be upside potential. And it's very interesting to see what happens. If it ever reaches that price level of 45, that's an upside potential of about 15%. Why? Omega Healthcare is interesting as a stock pick for this year. I personally wouldn't invest in it, but that's up to me. Maybe you see the potential in it. And keep in mind that, of course, you have volatility. With real estate funds, there is also an influence from interest rates, of course. And actually, it is the same if you invest in a real estate fund with a good long-term strategy. Then you actually always want to buy more when it drops by 20 or 30%. Those are the nice moments to buy more. And then you have the interim high dividend, which allows you to just wait patiently and collect dividends. The last top stock in this analysis is perhaps also very interesting for the long term, and we're going through it faster. But that's not it because it's the least interesting. Actually, it might be one of the better ones from this edition. In any case, for the long term, it's about the company Northrop Grumman Corporations. And as I said, I'm not known for my statements about companies, so I just call it NOC. The price is NOC today. And look, if we look at the analyst rates, they think there's still quite a bit of upside potential in it. Morningstar also indicates, yes, this is a company with a strong economic moat. The fair value estimate is significantly higher, 580 compared to the current price. So it can be very interesting. Also, if we look at the historical valuation, then it seems like he has walked a bit too far. But if we zoom in a bit for the short term, it's not that bad. And if we look at the forecasting, we see that the price to earnings is 17. Then we could achieve an average return of 7%. However, I would actually choose a somewhat lower multiple, for example, 14.7 or 15. Then we end up at 15 and we see a potential return of about 2% on average. Then at least you're being realistic and it might turn out positively because the EPS estimates are on the relatively cautious side at around 7%. It can still be interesting because you can buy the company at an intensive value, the fair value, or maybe even a bit below that. And especially for the long term, we will see that it can be very interesting. That price to earnings is currently around 16, so not super attractive. And the luck ratio is 1.3, which isn't very attractive either. Price to cash flow, normal. And we see that the dividend yield is about 1.7%, so it's not super high. Dividend. Finally, let's talk about the debts. 18 billion on the balance sheet. Watch out for that. The cash position seems quite healthy in the short term, but keep in mind they need to manage the debts, of course. Invest but it looks really good at the moment because the return on equity is very high and also the 5-year average. So that's actually really good in terms of profitability. Also in terms of dividend safety, growth, yield, and consistency, they score very high. Dividend yield of 1.8% for next year. Relatively low payout ratio. The 5-year growth, the ratio is 9%, so that's very high. And what you see is they have been paying out dividends for 21 years in a row or 35 years in a row. And for 21 years in a row, they have achieved dividend growth. So this is what they call it, a growth dividend stock. So a dividend growth stock, just putting the terminology aside. In the short term, a savings account gives a hold rating. And if we see in the very short term, at the moment, it's moving within a trading range. If we're lucky, the stock will drop by about 10%. It finds support here at this imaginary support level at a price of around 430. Then the upside potential does seem quite attractive. In any case, when it comes to technical analysis, about 25%, you might mainly want to buy this company for the long term. For the long term, it's about growth, and it's doing very well in that regard. So the valuation has gone up a bit, but it also has quite a few advantages because the economic moat is wide. In other words, a strong, sustainable competitive edge advantage. So maybe the most interesting of these 5 dividend stocks for the long term. That was it. Thank you for watching. And I would say until the next analyses,